Hello champions, welcome back, and today we are going to talk about the head and shoulder trading pattern. And basically what head and shoulder trading pattern looks like is, I will redraw this. Let me just remove everything. So you will have price. Let me choose a different color. You'll have price doing this: go up, form a high, then drop to form a low, go up to form a high, drop to form a low, and then the next high does not get to the highest point we've made so far, which is this point, and instead we will have price continuing lower. And then for head and shoulder traders, we know once price goes below this point, that is when we place a trade to go lower, and maybe a stop loss at this point or at this point. Okay. And then so what this means is basically now the head and shoulder pattern is price forms a high giving us a shoulder, then gives us a higher high giving us a head, and then it forms a lower high which now gives us another shoulder or the left. This becomes the right shoulder or the left, I don't know, one of the other shoulders. Now so what we are doing in this video, or let me show you the bullish situation first. So the bullish situation would be a price forming a low, a lower low, then lower high, and then a lower low, which becomes the lowest point. Then price comes back and forms a higher low and then goes up. So price failed to get to this low. Instead it gives us this one, and price breaking above this higher low, this high where price is reversing, and that is now where traders would now come in and take buys to the upside, a stop loss at this point or at this point. Okay, so what are we doing with this pattern? What we are doing with this pattern is we are adding a confluence or a condition that has to be met that will help us improve our win rate and also give us higher risk to reward ratios. And what I am about to add here will make you realize, or makes us realize, that ICT traders, especially 2022 model, are just head and shoulder pattern traders without realizing it, or the head and shoulder pattern traders are just ICT traders, especially for the 2022 model, without realizing it. The advantage ICT traders have is that they have an extra layer of confirmation, actually several extra layers of confirmation, and that is what you're going to talk about. But for this video, we are just going to add one more layer of confirmation that price is now going to give us, or is going to move in a direction we expect it to move to. Now and this one will need you to only add one thing, and that is what we call a key area, or a PD array, or a fair value gap, or a volume imbalance. While there are so many areas of interest you can add, maybe, or PD arrays you can add, this time you're only going to use something we call a fair value gap. Now also another thing we are going to do is just add one more task to the model, and that task will be to get this area of interest in the higher time frame instead of the lower time frame. So that means as a head and shoulder pattern trader, you have one more task to do to have a good time frame alignment, so that your trades move well. Now let me demonstrate that with a drawing, and then we'll get to live examples. So we have price forming a high, a higher high, a higher low, a higher high, and then price dropping to give us this low, and then to form a new high that does not get to this level. Instead, it reverses from this point and goes lower. Now what we are adding is the extra layer of confirmation is a key area or an area of interest, and in our example we are going to use a fair value gap. So this is FVG. So it can be that where price comes, the head of this head and shoulder pattern taps into an area of value or a fair value gap in our examples, right? And this has to be a higher time frame area of interest. Or another scenario would be this head and shoulder pattern is let me redraw that. This head and shoulder pattern is happening in an area of value. Let me just draw it covering the whole of it, and this is still a fair value gap or a higher time frame fair value gap, right? So we have the shoulder and then a head, a shoulder inside this fair value gap, and then once price drops, you want to get your entries to the lower side. Now what this is going to help us do, this price is moving in the lower time frame, for example in the 15-minute time frame. What is wrong with this 15-minute time frame? But the key area is from a 4-hour time frame. So that is what you are going to use. Let me give a bullish example. Bullish example is when we have price forming low, a lower high, then a low, this high, and then a new low, and then pushing up. Price has to do one of two things. The head or the inverted head of this pattern is tapping into a key area, that is a 4-hour time frame or whichever higher time frame you want to use, or this entire move is happening inside a key area, which is still a fair value gap or a 4-hour fair value gap. Now so that is the bullish example. Once price closes above that fair value gap, now you want to get into buys. As I have said, we are going to do this so that we get a higher win rate and a higher risk reward ratio, and we are going also to add one layer of confirmation in the lower time frame for us to get now those higher everything, higher risk reward ratio and higher win rate. Now let us go to the live examples on the charts. Closing this, I don't need to save it. Come here. Now coming to the charts, we'll start with gold. This is gold. Saturday, this is price is not currently moving, so it is a weekend. Saturday, 9th of August 2025, right? So I had already drawn this. We have this happening. Let me just redraw that. We'll see what is happening. So we have price doing this sort of thing, right? Give us that high, give us a low and then a sharp head, and then a low, and then a shoulder and drop like that. So this is our what is happening. This is our shoulder, and then a head, and then another shoulder, right? However, as I have said, we want to do this in an area of in an area of interest, or a fair value gap in our example, and I'll show you what that means. But as a typical head and shoulder trader, maybe you would have entered this trade, let me say at this point. Actually, I think we should move this. This is a significant low right there, right? Yeah. So the moment price breaks below that low like that, now you want to get into your sells and stop loss above that head, and maybe you are targeting a 1 to 2 or 1 to 3, whichever you like. I don't know, yeah, something like that. But let us see what we can add, right? So that we have a higher risk reward ratio and a higher win rate. First of all, we've said we want this to be happening in a key area. In our example, a fair value gap. Let us go to the 4-hour time frame and find out if we have anything. So this is our head and shoulder pattern right there. I can zoom in to see how it looks like in the higher time frame. High, a low, and then a head, which is the highest point, and then a low, then a lower high, and price drops. This price reacting of any area of value, yes it is. You can see right here we have a fair value gap. A fair value gap is a 3 candle pattern where the wick, in our example, the lower wick of this first candle does not meet with the higher wick of this candle right here. So this gap right here becomes our fair value gap, right? So that is what we mean by a fair value gap. So if you extend this to the farthest right, like this, let us extend it. Let's see, yep, is it in that area? Yes it is. So you will see this is now the 4-hour fair value gap. Price is doing that inside this 4-hour fair value gap. Dropping back to the 15-minute time frame, we see what is now happening in that area, right? So price has a tendency to do that. Price has a tendency to react off fair value gaps, and that is what gives ICT traders an edge or a confirmation, because a fair value gap is considered a volume imbalance, and it is expected that at some point in the future price will retrace back to this volume imbalance to balance it out. That is why we have these kind of reactions of these fair value gaps. Now, so we have this head and shoulder pattern forming inside this fair value gap, right? And you will also notice price does not close above it. That means this is a very strong area, and maybe as resistance. Is a resistance or support? This is a resistance area for people who are trading resistance. So also a resistance zone as a trader, or a resistance and support trader. This is also something you can look at, a head and shoulder pattern forming at a resistance zone or a support zone. So we have that happening. Now, as I had said, we are adding only one layer of confirmation to give us surety, or to give us some form of reassurance that price is going to move in the direction it is expecting us to move. So since we are adding a 4-hour fair value gap, we are also going to add another fair value gap in this time frame right here, in this 15-minute time frame, right? So we can see we already have price now breaking below this point, right? Now what would ICT traders call it? A market structure shift, right? And then as price is breaking below this point, it leaves us a series of fair value gaps. We have the first one here, and we have the second one right there. Now you'll notice this second one is where price reacts off of. Now as I have said, price will always react off fair value gaps. The moment price reacts off these fair value gaps, now that is your confirmation, another layer of confirmation that price is going to drop, right? So the moment we have this candle rejecting below this fair value gap, and then we have a strong engulfing bearish candle, right? This is a confirmation to you that price is now going to go lower. At this point is now where you're going to enter your sales, and because you're expecting price to go lower, our stop loss will be either above this fair value gap or this fair value gap, right? Now compared to what you would have done earlier, let me try and set compared to what you would have done earlier as a head and shoulder trader, your stop loss would have been at this point, which is a very big range of stop loss, and maybe you're targeting a 1 to 3. Let us see what that looks like. Targeting a 1 to 3 at around this point, right? So you can see that. But if you have a lower time frame fair value gap like this, giving you another confirmation that price is going to go lower, then there's no need to set your stop loss this high. Instead, you want to set your stop loss at areas where we have maybe these fair value gaps, or if you're targeting a high, target this recent high, and you will have a bigger risk to reward. You can see you have a 4.72, or at this point you have a 6.89. So that is a higher risk to reward ratio, right? So as I had said, we do this and you will realize that ICT traders are just head and shoulder pattern traders without realizing it. The advantage they have is they have extra layers of confirmation to ascertain them that price is going to move in the direction it is going to move. For example, now we already have this for our fair value gap, and then I'll just remove this. The next condition being met is price sweeps this high, right? ICT traders call it liquidity sweep to the high, and then the last bearish candle prior to this sweep becomes a breaker block, right? So we have this low, and then this right here, there's a breaker block right here. So this breaker is another one of those PD arrays or key areas where you would expect this to happen. So price breaks below it, retests it the first time, the second time, and the third time we have price now going lower, and this gives another confirmation price is going to go lower. Now the extra layers of confirmation we have is we have a market structure shift right here, this low market structure shift. Also now we have break of structure. At this point we are expecting price to move lower. Price gives us another shoulder right here and then comes lower. As it is moving lower, what does it do? It is giving us a fair value gaps, a series of fair value gaps on its way down. This fair value gap right here, price reacts off it again and gives us another clue that price is now going to go lower without without major retracement back. So this is another layer of confirmation, and then we have another layer of confirmation right here. So as a head and shoulder trader, maybe at this point you want to consider taking a trade here. The moment it retraces, price retraces. The moment price retraces into this fair value gap, you take your sales at this point, right? And if you set your stop loss at this high, you still have a very high risk reward ratio. That means even as this low is being broken, you are already in a trade and it is moving in your direction. Another layer of confirmation is this fair value gap supports price lower. If you missed this entry, you can take another entry right here, right? And that is how ICT traders are trading head and shoulder patterns without realizing it. The advantage is they have several layers of confirmation. As a head and shoulder pattern, you don't have to trade it as a raw pattern. Instead, have these extra layers of confirmation to help improve your win rate and risk reward ratio. So I will have a look at another example. I think we should be able to get one here. Let us have a look at this example. Just delete these ones. Right, so we have this example right here. I will draw our pattern. Right, so we have price making significant move to the downside, then forming a high. This is a lower high, and then giving us this low, and then giving us this high, giving us this low, and price keeps going up right there, right? So we have our shoulder, and then our head, and then our shoulder right there. So the moment price breaks above this point, we have what ICT traders call market structure shift, and then price give us this shoulder and breaks above this point. And as a head and shoulder trader, you want to place your buys at this point and stop loss there at that head, and maybe your 1 to 3. We see if we ever got that 1 to 3. Did we ever get? We see price really consolidated a lot at this point. Yeah, maybe almost before it moved down right there. So yeah, we have, let's see if it got to 3. I think it got to 3. Did it? Yes, it did. Did it? No, it didn't. Sorry. So it did not, but however, let us look if you would have gotten cleaner entries. Now, what do we have? Do we have an area of interest? In our case, it would be a 4-hour fair value gap. For our fair value gap, let's see if we have anything to the left. We have, I think we do have one. This fair value gap right here. Price reacts off the first time, the second time, the third time, and most likely it is reacting off it the 4th time right here. So removing these many shapes like this, try and clean it up, right? So that we have that fair value gap. Price is reacting off this fair value gap, right? This candle is the one that gives us the final confirmation that we are going to go up. Let us now go to the 15-minute time frame. See if we had anything meaningful at that point. So For our fair value gap, shoulder, head, shoulder, right? So as price is breaking above this point, or what we call a market structure shift in ICT, you will notice price left a fair value gap right there, right? And we had price reacting of this fair value gap. So price gives us this market structure shift or break of structure, goes up, retraces into this fair value gap, and then goes up. Now this fair value gap is your area of interest in the lower time frame, right? The moment price closes above this fair value gap, what do you want to do? You want now to enter your buys right there. No, here, because we have this bullish candle. So as an ICT trader, you would have placed your stop loss there and targeted your 1 to 2, 1 to 3. Let's see. Initially we saw that it didn't really get to that 3. I think it would have gotten it to it much later. If you took a buy at that point, yeah, it would have gotten to that risk reward ratio of 3. But because we have this fair value gap forming our reaction or our support or whatever you would like to call it, our stop loss will not be there. Instead, our stop loss will be at this low right here, or just below that fair value gap, right there, or below this low right here. So with that in place, let us see how our risk to reward ratio has significantly improved. Now we have a 10.36 risk to reward ratio. Assuming you don't even want to go that far, you would have targeted these highs, giving you 6.47, and then these relative equal highs right here, giving you an 11.28, which is a very good risk to reward ratio, right? But now that would mean you have to hold your trade a bit longer, right, like that. So from Monday to Monday the other week, which is if you have the patience, that will be good. But if you don't target this high right here, and that high was tagged, and that was a 6.3 risk to reward ratio, which should have happened from Monday at 10:45 to Tuesday at 9:45. A very good trade right there. Let us look at another example. This is gold. Let us look at maybe Euro JPY. Did we have anything? We did. This is a head and shoulder pattern. Is it reacting off an area of value? Let us go to the 4-hour time frame. Is it reacting off an area of value? And as see, it is. You can see right here this massive fair value gap right there. So the head, the shoulder, the head and the shoulder are inside this 4-hour fair value gap. Back to the 15-minute time frame, what do you want to see? You want to see that market structure shift, another one, break of structure, and we have a fair value gap now. Price has already given us an intention to go high by giving us this break of structure, right? This retracement is to balance out this imbalance or this fair value gap, which you call fair value gap or volume imbalance, right? So price closes above it like this candle right here, and that is your cue to get into a buy trade. Stop loss just below this fair value gap or this low right here, right? And then you want to target these highs, which would give you what, a 2.97, right? Did we get anything else? These relative equal highs right there, and this would be a 3.95. Any other thing? Maybe if this price keeps going up, it will go to these highs, which would be on Monday, giving you a 12.21, right? Price is not currently moving because it's weekend, but assuming you are strong enough to hold it for that long, you can go ahead and target those highs. Do we have, let me look at Euro USD. I think we had something on Euro USD, live examples. These are live examples, by the way. So we have the shoulder, a head, and a shoulder. Is it reacting off a key area? Yes, it is. We have this 4-hour fair value gap right here. This 4-hour fair value gap is where price is reacting off of, right? So it gives us this reaction. Price attempts to go higher, but instead it turns or reverses, giving us a head, and then we have a shoulder now. This shoulder still taps into this 4-hour fair value gap. You can see right there. Now, what do we have? We have a significant market structure shift at this point, right? As this price was moving lower to give us this market structure shift, it left us with several fair value gaps that price would maybe want to react off of. Let me remove this. So this is the first fair value gap, that this rectangle you can see here. You can increase the opacity a little bit right there, and then you have now price reacting off it, giving us a clue that it is going to go lower. Market structure shift giving us another confirmation it's going to go lower, and this retracement is to balance out this fair value gap now. And you can see this is what happened at this point. Right, the moment price closes below that, you will want to get an entry at this point here, stop loss at this high and this high right here that gave us this fair value gap, right? And you want to target, assuming, let us try and get that 1 to 3 first. Stop loss above this head, and then we have 1 to 3 at this point around there. But assuming we move our stop loss to just at this high that gave us this fair value gap, what we have 6.23. And now for someone who has the balls to hold the trade a bit longer, target this relative equal lows right here, and that would be your 8.91 risk reward ratio. If you missed that, you're saying you missed that, let us look at what else you would have used. Right, price gave us another fair value gap right there, right? The moment this fair value gap, the moment it is retraced or retested, it is a very long time for you to come to the charts and take another entry, right? Assuming you missed this one. If you missed this one, this was another entry you would have taken, right? So take a trade at this point, and this would also be a very good risk to reward ratio. Let us have a look at that right there. Stop loss just above this move that gave us this fair value gap, right? So we have 3 at this point, and then targeting relative equal lows, you had a cool 15.58 R, right? Even if you are saying that stop loss is too tight, let me expand it a bit and see what would have happened. This point here, can see that it still gave us a good 9.32 risk to reward ratio. Assuming you missed that entry, you still had another opportunity. Well, remember the price has not broken below this point, so you have several entries right here. Another fair value gap, right? This is enough time for you to get into this entry. 15 minutes, 30 minutes, 45 minutes. 45 minutes and you get another entry right there, assuming you missed the first 2 entries. Entry right there, stop loss at this high or at the high of the candle that give us that fair value gap, targeting again those relative equal lows. targeting those relative equal lows at this point, and we have that, right? 5.96. So those are the examples I was showing you live on the charts, and this is not so long ago, this is just recent, but you can go out there and back test it and see if it will work for you. Ideally, the purpose is to know that the purpose in this video is to know that price always moves because of two reasons. Number one, to fill out imbalances, which are fair value gaps, and to clear out highs and lows. And in this case, we are using fair value gaps, or those volume imbalances, to add an extra layer of confirmation to our head and shoulder pattern to increase our profitability. So it is now up to you to try and backtest it and see if it will work for you. That's it. Have a fantastic trading time. Until next time, adios.